They tell you the market rewards speed, that if you don't act, you'll miss your chance. It's a myth whispered in every trading room, disguised as urgency, reinforced by the glowing lure of moving prices. The truth is far colder. In Wyckoff's world, momentum is the mirage that traps the impatient. He observed that when the crowd begins to chase, the professional quietly begins to sell. What the novice sees as opportunity, the composite man sees as exit liquidity. Momentum, in this light, is not a beginning but an ending, not the start of movement, but its exhaustion point. Every trader remembers that feeling. The chart breaks a high, the candles surge, volume explodes, and conviction rushes in like adrenaline. You click buy. A moment of satisfaction follows, then uncertainty, then confusion, as the same chart begins to drift sideways or bleed back into your entry. It is not randomness. It is the design of accumulation and distribution doing their work. Wyckoff taught that the market moves only after preparation, and every sudden breakout is merely the public's delayed recognition of a cause long completed. By the time you see momentum, the professionals have already measured it, tested it, and positioned themselves. The illusion persists because it flatters the ego. Chasing a fast market feels like participation in intelligence, like catching the wave before it breaks. The mind confuses movement with meaning, mistaking volatility for opportunity. But the composite man, as Wyckoff described, never moves with emotion. He plans his campaigns months before the public senses them, building cause quietly, distributing effort invisibly. The trader who reacts to motion is, therefore, reacting to history. What he buys today, the professional built yesterday. Wyckoff's writings speak with the patience of an architect. He viewed markets not as random fluctuations, but as deliberate sequences of preparation and result. When he spoke of the law of cause and effect, he was speaking about time, the unseen dimension that amateurs ignore. He taught that a rally born without preparation is doomed to failure, because it lacks the internal energy, the cause, necessary to sustain its movement. A chase entry, then, is not just risky, it is an argument against physics. The trader is buying effect without cause, result without reason, outcome without origin. Look closer at any true breakout that endures. Before it, you will find a base, a slow, patient absorption of supply, a narrowing of volatility, a silent drying up of volume. These are the footprints of the professional. The chart, in this state, is not quiet because nothing is happening. It is quiet because the real work is being done. The accumulation phase is the gestation of movement. When you learn to read that preparation, momentum becomes irrelevant. The professional waits for the test, that final confirmation that the market's cause is complete, and only then commits. The crowd can't stand that stillness. It confuses inactivity with missed opportunity, silence with boredom. But Wyckoff understood that waiting is participation too. Each phase of the market communicates intent. The markup is not where money is made. It is where profit is distributed. The accumulation is where value is built. The professional's profit lies in the distance between these two perceptions, between what is real and what is seen. To stop chasing trades is to accept the slow rhythm of logic over the fast pulse of emotion. It demands that a trader reverse his instinctual clock to see strength not in breakout candles, but in the drying up of supply, to find excitement not in motion, but in preparation. It means learning to interpret volume surges not as signs of opportunity, but as signals of completion. Wyckoff students learned that when volume and spread expand dramatically, effort has reached its peak. The crowd is finally reacting. The professional, by contrast, is already calculating exit zones. This inversion of perspective is uncomfortable at first. It feels counterintuitive to wait when the market is moving, to step aside when others rush in. Yet that is the precise moment when timing begins. Wyckoff's discipline is not about predicting where the market will go, but about knowing when it has already gone. The illusion of momentum fades only when one sees that speed is not power, but exhaustion disguised as strength. The trader who learns this begins to move differently. Instead of scanning for breakouts, he watches for evidence of preparation. The contracting volume, the dull sideways drift, the failed attempts to push lower that signal quiet absorption. He begins to sense the invisible hand of the composite man, orchestrating movement beneath the surface. Each candle becomes a clue, not a command. In this mindset, the chase ends. The trader ceases to argue with the tape and begins to listen to it. There is dignity in that stillness. It separates the disciplined observer from the emotional crowd. Momentum may look glamorous on a screen, but it is the patient phase before it, the silent alignment of cause and effect, that holds the real opportunity. Wyckoff's greatest secret was not a pattern or indicator. It was the timing that comes from understanding preparation. And that timing begins the moment a trader stops running after the market and starts letting the market come to him. The market does not move because of news, headlines, or sudden inspiration. It moves because sufficient cause has been built beneath the surface. This was Wyckoff's most powerful revelation, that price movement is not spontaneous but consequential. Every advance and decline is the visible result of invisible preparation. To the untrained eye, a rally seems like magic, a burst of collective optimism, but to the trained observer, it is merely the effect of an accumulation that has quietly matured. The market's true clock does not tick by seconds or minutes. It ticks by effort, by the slow absorption of supply and the deliberate creation of demand. Wyckoff called this balance the law of cause and effect. It is a natural law, as consistent as gravity, binding every market movement to the amount of work that precedes it. When accumulation forms over time, when professionals quietly absorb shares from weak holders, when volume contracts and volatility narrows, they are not being passive. They are building a cause. That cause, once complete, has a measurable energy that must eventually express itself as movement. The markup phase is merely the release of that stored energy. To understand timing, therefore, one must learn to measure the unseen, the span and character of the cause, before the effect begins. This perspective transforms chaos into rhythm. It allows the trader to think in terms of preparation rather than prediction. Most participants live in the effect phase, reacting to price motion as though it were born in the present. They watch candles expand, volume rise, and believe a new trend is beginning. In truth, the trend began long before, when price moved quietly sideways and interest waned. The market was not asleep. It was incubating its next move. When the breakout comes, the effect merely reveals what the cause had already guaranteed. Wyckoff often compared this process to agriculture. A farmer does not expect a harvest until the ground has been tilled, the seeds planted, and the season allowed to mature. The act of harvesting is brief, but the preparation is long. Traders who understand this analogy stop expecting instant results. They begin to think in terms of accumulation time, depth of absorption, and volume character. They measure whether the market has earned its next move. In this way, timing becomes an act of recognition rather than prediction. The law of cause and effect also reframes the meaning of sideways markets. What most call consolidation is not indecision. It is creation. Every base, every trading range is a construction site. The composite man is at work, testing supply, shaking out weak holders, and balancing effort with result. When the cause reaches proportionality, the effect follows with mechanical precision. This is why Wyckoff's method feels almost prophetic to those who apply it correctly, not because it foresees the future, but because it reads the present with depth. Understanding this law gives structure to time itself. The impatient trader treats time as an obstacle, something to be endured between trades. The Wyckoffian treats it as data. The longer the cause, the greater the potential effect. Time becomes a dimension of measurement, not merely waiting. When you study a base that has spent months absorbing supply, you are measuring the stored potential of that market. A small rally emerging from a shallow base will likely exhaust itself quickly, for its cause is insufficient. But a breakout from a deep, well-constructed accumulation can travel far, because it has the stored energy to do so. This reorientation toward cause and effect restores a trader's sense of calm. It strips away the randomness that breeds fear. When you know that every effect must have a preceding cause, the market becomes readable. The panic of volatility gives way to logic. You begin to observe rather than react. Volume surges no longer frighten you. They inform you. Extended bases no longer bore you. They assure you. You start to see that timing is not a question of guessing when, but of recognizing that the necessary preparation has concluded. Wyckoff's teaching here was deeply moral as much as it was mechanical. He believed that understanding cause and effect instills discipline because it demands patience. It prevents the trader from confusing activity with progress. The market, like nature, rewards those who respect its processes. To violate them, to seek effect before cause, is to invite ruin. Every impulsive entry, every attempt to force timing, is an act of defiance against this law. But those who wait for the market's cause to mature align themselves with the natural order of movement. Once this principle takes root in a trader's mind, the market's chaos softens into clarity. The noise of news fades, the obsession with prediction dissolves, and what remains is observation, the quiet study of structure forming over time. To act too early becomes as irrational as harvesting before the seed has sprouted. Timing, then, is not speed, but synchronization, the discipline of acting only when the unseen cause is complete. And in that alignment lies the difference between the speculator's chase and the professional's precision. Every market move is an expression of energy. Wyckoff taught that the only way to read this energy was to compare effort with result volume against price. It is one of the most deceptively simple ideas in all of market logic, and yet it separates those who see from those who merely look. Effort is what the market expends. Result is what it achieves. When the two align, the movement is genuine. When they diverge, the market is telling you something about its internal condition. In that relationship, timing begins to emerge, not as intuition but as diagnosis. Volume is the crowd's voice, and price is its footprint. Together they form the dialogue between strength and weakness, intent and outcome. A bar with widespread and expanding volume speaks of alignment between effort and result, buyers or sellers moving with conviction and being rewarded for it. But when volume increases sharply while price progress shrinks, something deeper is happening. It is as if the market inhales but cannot exhale. Professional hands are absorbing what the crowd is throwing, and that absorption tells the trained observer that the composite man is active. The inexperienced trader, however, misreads this condition. Seeing effort, he assumes continuation. The professional, seeing lack of result, suspects reversal. This principle mirrors nature itself. In every system, energy must convert efficiently to sustain motion. When the effort becomes too great for the achieved outcome, the structure weakens. A river that swells without widening its channel begins to overflow its banks. A market that trades heavy volume without directional progress begins to signal exhaustion. Wyckoff read these imbalances as symptoms, not events. He did not predict from them, he interpreted through them. His genius was in realizing that the market's health could be read from its efficiency. To understand effort and result is to learn how to hear the market breathe. Every wave of buying and selling has a rhythm, expansion and contraction, exertion and rest. The experienced trader senses this rhythm, the way a physician listens to a heartbeat, noting when it quickens without cause or slows under strain. A sudden surge in volume followed by minimal price change is not noise. It is resistance or absorption. It means professional interests are at work, testing how much supply remains in the market. A decline that occurs on shrinking volume is not weakness. It is a sign that selling pressure is dissipating. This reading of volume and spread becomes a language, one that replaces guesswork with observation. What makes this principle transformative is its subtlety. It doesn't scream for attention. It whispers through relationships. Traders seeking excitement overlook it because it lacks drama. It requires detachment, the willingness to look at each bar and ask not what happened, but what should have happened, given the effort displayed. If a strong volume thrust fails to move price, the professional knows demand has been met by hidden supply. If low volume manages to push price easily, it shows that opposition has thinned and the path is clear. Each observation becomes a clue in deciphering intent. Wyckoff's mastery lay in linking this analysis to timing. When the market shows consistent alignment between effort and result, it is confirming strength or weakness. The trend is intact. When that alignment begins to falter, when volume expands but progress stalls, When price rises on diminishing participation, the structure is shifting. The professional doesn't react immediately. He observes the change, waiting for confirmation that the character of the move has altered. Timing is born from these turning points, the subtle fractures where effort no longer produces corresponding result. The emotional trader rarely perceives this breakdown because he equates movement with meaning. He believes the tape is a contest of direction rather than of energy. Wyckoff inverted that belief. For him, direction was merely the surface. The true market lay beneath, in the struggle between effort and efficiency. The one who measures this relationship stops being a victim of volatility and becomes an analyst of equilibrium. He understands that every climax, every exhaustion bar, every sudden reversal is simply the inevitable reconciliation of effort and result. When you begin to observe the market through this lens, a strange calm settles in. The noise of every candle loses its power to provoke reaction. You start to wait for confirmation, for the effort that actually moves something, for the result that validates intent. This is how the composite man reveals his hand, not through headlines or sudden drama, but through consistency of cause and proportionality of effect. When the market's pulse becomes erratic, the professional does not chase. He listens. He knows that imbalance always precedes transition, and imbalance is visible in the widening gap between what the market tries to do and what it actually accomplishes. Reading effort and result is not an act of prediction. It is an act of respect, an acknowledgement that price is the market's response to energy spent. The trader who grasps this no longer trades in hope. He reads, waits, and responds when the heartbeat of the market steadies into alignment once more. It is in that alignment, in that moment when effort and result breathe in harmony, that the discipline of timing reveals its quiet perfection. Timing is the bridge between knowledge and action, and Wyckoff's greatest insight was that it is not found in price alone, but in the convergence of subtle signals that confirm intent. The market is not a random sequence of movements. It is a carefully orchestrated display of preparation and testing. Every rise and fall carries a message, and only by understanding the language of confirmation can a trader know the precise moment to commit. The rule is deceptively simple. Act not at the first sign of strength, but after the market has verified its own readiness. This is the essence of Wyckoff's timing rule. The market communicates through structure, volume, and price behavior, offering a series of micro-confirmations that indicate whether a move has legitimacy. The professional watches for these signs with patience, noting where supply has been absorbed, where weak hands have been expelled, and where the tape itself has tested the resilience of the trend. A test of absorption, for example, is not a dramatic surge, but a measured reaction that shows whether the market can rise without encountering hidden resistance. The subtlety is critical. This is why so many traders enter prematurely, mistaking raw volatility for confirmation. Timing is revealed only when the market has silently proven its capacity to move. Confirmation is layered. First, the trader observes that the market has successfully absorbed prior selling. This is evident when price approaches a previous resistance or low volume reaction and holds without surrendering ground. Second, the market demonstrates internal balance, a brief consolidation with narrowing spread and subdued volume. This quiet period is not indecision, it is preparation. It signals that the necessary supply has been absorbed and that the stage is set for expansion. Third, the market resumes movement with renewed strength and expanding volume, demonstrating that the effort is now matched by result. Only then is commitment justified. Acting before this alignment is speculation. Waiting until it appears is mastery. Understanding these signatures requires more than mechanical observation. It demands an attunement to the market's rhythm. Each candle, each cluster of bars, is a beat in the market's pulse. The professional does not see randomness. He sees patterns of energy converging toward inevitability. The timing rule is a mental framework for interpreting these convergences. It allows the trader to step aside during false moves and to concentrate attention on moments when the market itself has cleared the path. Acting at these points is not impulsive. It is synchronization with the tape's internal logic. The paradox of Wyckoff's timing rule is that it rewards patience with speed. By waiting for confirmation, The trader positions himself at the point of least public attention but greatest professional participation. The crowd sees the breakout and reacts emotionally, chasing the move, while the prepared trader enters precisely where the potential for profit is maximized and risk is minimized. In essence, timing is about choosing the instant when the market's structure has aligned with probability, where supply is under control and momentum is ready to carry the position forward. This approach redefines conventional notions of early entry and getting in at the bottom. The professional does not seek a perfect low. He seeks verification. Markets do not move linearly, and attempting to anticipate exact extremes is futile. What is predictable is the sequence of confirmation: absorption, balance, resumption. Each element serves as a checkpoint, a signal that the cause has matured into effect. By following this sequence, the trader is not guessing, he is responding to evidence. The discipline required to adhere to the timing rule cannot be overstated. It is easy to see a spike in price or a surge in volume and feel compelled to participate. Human nature favors action over observation, hope over analysis. Yet the professional knows that discipline is the true edge. By waiting for the market to demonstrate readiness, he avoids the traps of premature entry and emotional conviction. The timing rule becomes both shield and compass, guiding when to act and, equally important, when to remain patient. Applying this rule transforms the way one perceives the market. Instead of reacting to every movement, the trader learns to listen for structural intent. The eye shifts from the drama of volatility to the quiet choreography beneath it. Each signal becomes a piece of a larger puzzle, the puzzle of timing, where cause has completed its work and effect is ready to emerge. The moment of entry is no longer arbitrary. It is chosen with precision, validated by the market's own behavior. This is the power of Wyckoff's timing rule, the ability to step from observation into action with absolute clarity and discipline, turning preparation into opportunity and restraint into advantage. Even the most meticulously prepared trader is vulnerable to an insidious adversary, the mind itself. Wyckoff understood that while the market obeys natural laws, the human psyche does not. Timing, no matter how precisely calculated, can be destroyed by emotion. Hope, fear, and impatience are the silent saboteurs of otherwise perfect trades. The moment a trader allows expectation to govern judgment, the law of cause and effect is overshadowed by the law of desire. The market moves according to its own rhythm. Yet the human observer imposes his own timing, often at the wrong moment. Hope is the most common and dangerous trap. A trader enters after observing the market's confirmations, only to watch price hesitate or retrace slightly. The mind whispers, it will recover. It must continue. Small fluctuations that would be inconsequential to a disciplined observer become sources of anxiety. The trader holds, buying into illusion, convinced that patience will be rewarded. Yet hope is not strategy. It is an emotional gamble. Each tick against the position is magnified, and the trader begins to see opportunity not in evidence, but in desire. Wyckoff repeatedly cautioned that hope is ruin in disguise, and the market, indifferent to emotion, will punish those who rely upon it. Fear is equally deceptive. When a trade fails to move quickly in the anticipated direction, the trader doubts his original analysis. He wonders if the signals were misread, if the timing rule was misunderstood, if the market has conspired against him. Fear contracts decision-making, pushing the trader toward premature exits or partial participation. Every small loss looms larger than it should, because the mind interprets price action as judgment rather than observation. The professional learns to see fear as noise, a distraction from the structural realities of the tape. Fear, left unchecked, converts a calculated position into reactive behavior, and reactive behavior is the enemy of timing. Impatience, often intertwined with hope and fear, manifests as the constant urge to act before the market has fully confirmed its intent. The trader watches the consolidation, sees volume rising, sees price testing previous highs, and acts preemptively, reasoning that he is getting in early. The professional recognizes that such impatience is exactly what the composite man counts on. By entering too soon, the trader positions himself in the part of the market where absorption is incomplete, where hidden supply still lurks. What feels like foresight is actually a surrender to the emotional rhythm of urgency. Patience, Wyckoff teaches, is not inactivity. It is the disciplined alignment of action with evidence. These emotional tendencies often define archetypes of failure. The hopeful hero buys on promise and holds on expectation, believing that a few candles against him are temporary aberrations rather than structural realities. The fearful scalper reacts at the first sign of hesitation, abandoning positions before the market demonstrates completion. The impatient prophet seeks perfection in timing, chasing setups that have not yet proven themselves. All three share a single flaw. They attempt to impose their internal timing on the market, rather than respect the market's external timing. The lesson is clear: emotional timing is always weaker than structural timing. Wyckoff's brilliance lies not only in identifying market structure, but in revealing this inner battlefield. True mastery requires awareness of one's own impulses and the discipline to override them. The trader must observe hope as illusion, fear as distortion, and impatience as misalignment. Only by stepping outside these emotional currents can one respond to the market's own signals rather than the mind's reaction to them. This psychological neutrality transforms perception. Price fluctuations no longer trigger judgment. They convey information. Volume expansions and contractions are read with objectivity, not colored by desire or dread. The difficulty is that emotional timing feels urgent. The mind equates inaction with opportunity lost, and even a prepared trader can succumb to the temptation of forcing participation. Wyckoff understood that this internal struggle is as consequential as any market move. Discipline, he argued, is not merely about following rules, it is about achieving mental equilibrium. The professional who conquers his emotions aligns himself with the market's pace, entering when evidence confirms readiness, holding when the structure dictates, and exiting only when absorption, balance, or exhaustion reveals it. In this context, timing is as much a moral challenge as it is a mechanical one. The trader who cannot master himself will inevitably misread the market, for the strongest signal becomes distorted by desire. Hope, fear, and impatience act as lenses that blur observation, turning clear signals into confusing noise. By recognizing these forces and deliberately stepping outside them, the disciplined trader restores clarity. The internal clock is synchronized with the market's external rhythm, and in this alignment lies the quiet power that turns preparation into opportunity, observation into mastery, and patience into advantage. Mastery in trading is not born from constant action. It is cultivated in the spaces between movements, in the pauses where the market communicates its intent and the trader listens. Wyckoff understood that the greatest opportunities arise not from chasing momentum, but from aligning oneself with the natural rhythm of the market. The discipline of silence is the convergence of knowledge, observation, and patience, a state where the trader's mind is still, receptive, and attuned to the unfolding cause beneath the surface. It is here, in this quiet awareness, that timing transforms from abstraction into precise, actionable clarity. The market is perpetually in motion, yet not every movement demands engagement. The professional learns to discern meaningful activity from noise. A flurry of candles or a sudden spike in volume does not inherently signal opportunity. Instead, these events are interpreted through the lens of preparation, confirmation, and alignment with the underlying cause. By observing without the compulsion to act, the trader cultivates an understanding of the market's pulse. Each subtle contraction, each hesitation, each measured test of supply becomes a signal, a guidepost toward moments where action is justified. In this silence, the trader is neither passive nor reactive. He is fully engaged in the act of observation. Silence is more than absence of action. It is the refinement of discipline. It is a moral as well as a practical principle, reinforcing the idea that restraint is often more profitable than impulsivity. The trader who acts without evidence risks capital. The one who waits too long risks irrelevance. The discipline of silence teaches the balance between these extremes. It trains the mind to perceive signals without judgment, to distinguish between transient disturbances and meaningful confirmations. Patience becomes an active skill, a deliberate calibration of attention to the moments that matter most. Within this discipline, timing is no longer a matter of guessing or hoping. The careful observation of volume, spread, and price behavior reveals when the market's cause has fully matured. A consolidation that once seemed inert is recognized as preparation. A slight uptick in volume at a low point is read as absorption. The first signs of an advancing move are not triggers for immediate action, but confirmations that the system is functioning as intended. The trader's role is to respond, not to force, to synchronize, not to override. The market becomes a partner in this process, and its signals are the cues for measured, confident participation. Emotional neutrality is inseparable from this process. Without the discipline of silence, even perfect understanding of effort, result, and timing can be undone by hope, fear, or impatience. The trader must cultivate a mind capable of observing without attachment, of valuing evidence over expectation. This neutrality does not diminish engagement. Rather, it sharpens perception. Every candle, every volume surge, and every pause becomes intelligible. The professional reads the market's intent as clearly as a physician reads vital signs. By mastering internal timing, the regulation of one's own impulses, the trader harmonizes with external timing, the market's natural cadence, and operates at a level beyond reaction. The practice of silence also instills a profound humility. The market's movements are vast, complex, and indifferent to individual desire. The disciplined observer learns to respect this reality, to recognize that control is illusory, and that alignment is the true source of advantage. Each opportunity is not a conquest, but a response to conditions that the trader did not create. This perspective reframes success, emphasizing preparation, comprehension, and patience over forceful execution. Mastery becomes less about domination and more about synchronization, less about acting quickly and more about acting appropriately. In this state, the trader's decisions are informed by both law and observation. The law of cause and effect, the effort-result equation, and the timing rule are no longer abstract concepts but living guides. Silence allows these principles to operate within the mind without interference from emotion. The trader watches, measures, and responds only when conditions are confirmed. Entry points are chosen with clarity, exits with prudence, and holding periods with confidence. Every movement is intentional, every decision aligned with evidence. The discipline of silence is the culmination of all prior lessons. It integrates knowledge of market structure, mechanical timing, and psychological mastery into a coherent approach. Action arises not from urgency but from alignment, from recognizing that the market has completed its preparation and the cause has matured into effect. Patience is not idle, it is strategy. Observation is not passive, it is analysis. Timing is no longer elusive, it is earned. Within this stillness lies power, precision, and the subtle art of trading in harmony with the market's own rhythm. The professional emerges not as a force of impulse, but as a disciplined participant in a system far larger than any single desire, and in that participation, opportunity becomes both clear and inevitable.